What is the impact of the work from home movement and how this is affecting the commercial real estate operators and portfolios? Why Section 8 is the next up and coming industry for investors? Where is the future for condos and multifamily projects post-COVID? You'll hear from the experts as they discuss these hotly debated topics and share what they are excited about, from investment opportunities to PropTech. This is episode 14 of our Crowdcreate Mastermind Series, and this is the insight you need to get ahead in the real estate industry.
Welcome to the Crowdcreate Real Estate Mastermind. The purpose of this is really to bring together thought leaders like yourselves and leverage what we call wisdom of the crowds. Basically, you're all thought leaders and you're working on something truly exciting. We have a good mix of everybody from sponsors to investors to consultants, developers, and whatnot. And these masterminds are typically an hour long, where you go around the room and you share three things. Number one, who are you and what are you working on? Number two, what are you most excited about in the real estate industry right now? And number three, are there any challenges or how can the community help you right now? And the format of this is really to bring value to whatever it is that you're doing, share and highlight it and build some awesome connections along the way. There's a lot of returning, guests to this and good friends. So let's go ahead and kick it off and get started. Rob Sechrist, would you like to go first? Because this is your second one, I believe.
Yeah, well, thanks. I think I'm in the whatnot category. But we're the first cannabis-focused value-add bridge lender in the nation. We actually facilitate the acquisition or refinance, the build-outs, ground-up construction, or tenant improvements and equipment all in one capital stack. For all of the brands out there, they need to have properties to be growing or doing their cultivation, their dispensaries, whatever it might be across the nation. All of the properties that already exist are not eligible to be utilized until they've been improved for that usage. So we've done 46 transactions for 144 million with 20 payoffs so far. We launched the first private mortgage REIT for this sector in 2018. And that's the primary vehicle that we use to fund all of our transactions. We closed Acreage Holdings last quarter, and we have a couple of more pretty major announcements of who we're closing this quarter in the next probably 3 weeks or so. But that's basically what we do. That's what we focus on. It's a unique asset class. The cannabis use tenants have about 10 to 15 times higher income than traditional tenants. But the tenant improvements and the build out for the properties and the licensing is very complicated. And there's so many things that everybody needs to navigate. There's about 100 lenders in the space already. There's 8 FDIC insured banks already lending and 1 publicly traded. So it's already pretty well established, but nobody's doing the value add, and that's our specialty. Thanks.
Thanks, Rob. Is there anything that we can help you with as a community or any challenges you're facing? I know that I'm personally an investor in Rob, and there's actually another investor in here that's part of the same 506 group. We all speak very highly of you and very satisfied with the performance. And
yeah, well, I think that the performance was pretty good the last 3 months. It was above our projection of, we did over a 24% annualized net yield the last 3 months in a row without any leverage, and our target yield is 15. So we're pretty proud of that. We're just continuing to aggregate capital. We can't take another loan. We've got over 250 million in the pipeline. We're trying to get 150 million down this quarter. So we're just continuing to aggregate capital, and what we focused on is retail investors and not institutional investors has been the fastest way to grow. So that's what our focus is on, investors.
Any feedback from the audience? I do know with cannabis in the news right now, things are good and it sheds a lot of light on what you're doing, Rob.
Yeah, it's interesting times.
Nice. Any questions or comments, or we can go on?
I'm assuming you're asking from the audience, and I can't see or hear.
So for the audience, they can always chat. You feel free to write into the chat, but also from the other panelists, we'd love to hear if you have any comments or questions for Rob.
Rob, do you loan on hemp production too? A buddy of mine's
We
growing
don't.
hemp.
We only do commercial buildings, and hemp is traditionally an ag play, and it's just, we don't want to be in the farming. We want to be able to repurpose that asset if necessary. So we're interested in it, but not from the traditional sense. We're interested in it as a commodity for additional types of building, aggregate and things like that. We think that's the longer term play, not to pull out CBD and that. It's just too much of a commodity.
Got it. Thank you.
Rob, with the recreational side, I know a lot of states are starting to legalize it. One of the things I've seen in my area here in the Northeast is just the pushback from the debt institutions, banks, to kind of be willing to take on board a business as a partner to have on board, used for banking, used for savings, money in business in general. Are you seeing that kind of become a little bit less restrictive from where you sit nationwide, or is it more regional?
So FinCEN has approved 610 depositor relations across the nation. All of those are for depositor relations, and that's for tier 1 banking, which is cannabis operator, which is plant touching and allows for cash. So typically you're paying for those deposits to board that deposit. And then there's tier 2/3, which is ancillary, which is what we are. And of those 610 depositors, there's probably over 100 that are lending directly. And of those, 8 of them are FDIC insured lenders, and there's 1 publicly traded. So it's already happened. Now, those have been in place for over 4 years. Just the retail investor is not aware of how far the industry has matured and what's going on. We did get kicked out of our bank, which is Union Bank, because they looked at our website and they saw a pot leaf in there. Even though we're non-plant touching, we don't do anything with cash. And they exited not only our bank, but every single account that we had 40 trust accounts, $20 million, and we had to have it all out in 30 days. And that's kind of some of the blowback that you can get. And we quickly pointed out to them that 40% of our deposit of our borrowers' payments were coming from their accounts. So they really didn't want to have any more questions with us, which meant that they were banking cannabis businesses. And even though they didn't want to go any farther in figuring out what was going on. So they were already banking these depositors and didn't know it.
John, would love for you to go next and share what you're working on.
Well, great, Jeff and Ivan, thanks for having me. This is wonderful to see so many folks in the industry here. Did a little research on you guys, and you guys are doing great stuff. But my name's John Rubino. I live in Northern Virginia, right outside of Washington, D.C. Born and raised in Brooklyn, New York. 20 years as a Navy pilot. And in 2013, with about 4 years left to go in my Navy career, I decided to stand up a passive real estate investment business. I had a lot of friends who were active in the community and in the industry. And I networked pretty hard when I was here in the area, met some wonderful folks. And I decided that I wanted to be more on the passive side, coming in as either an LP or co-GP to assist sponsors who are out there doing all the heavy lifting. So what I did was I set up a business model where we partner with active sponsors in commercial, mixed use, and residential real estate. Focus areas, Washington, D.C., south to Florida, west as far as maybe Tennessee. And we partner with these folks. We bring in their equity. We help bring in anywhere from about $500,000 to $5 million on a project by project basis. Typically coming in under a 506 B or C. Just depends on the opportunity, the complexity of the deal, the scope. And we raise capital on the other side of the business through, which started out with first friends and family, has now become a large segment of public accredited and high net worth individuals and businesses. So we're at about 180 investors right now, and we are growing. And we offer an opportunity for each of our investors to come in to partner with us with our own capital. And we raise that money again on a deal by deal basis to come in on a specific opportunity. So our investors can participate on a $1 million, $3 million, $5 million raise or equity subscription or syndication with our already vetted partnered sponsors. And we then raise that capital through that pool of investors who come on board they see who we are, they get used to us and our process, they come visit us, come see our projects, and then are in a position to see our pro formas, our offerings to our sponsors, and have the opportunity to invest between 25 and 50,000 a project. So it's a nice entry point to get their toe wet at that level of investment, but combining that capital with up to the 180 investors at their discretion, we can bring in, again, like I said, between $500,000 to $5 million a project. So we fill a need for sponsors who have that general equity slice in the capital stack real well. We can bring in about 90% of that general equity, and it gives them the opportunity to the resources they need from a private money or equity standpoint is not overwhelming for them when they can come to a business like us. And we're kind of almost an arm of their investment, where we can do all the heavy lifting for them, deal with the investors, handle all the due diligence at our level. And my goal is to really bring a nice project that's been vetted. We've done the analysis and hand it off to our investors, who then have the opportunity to work with us to see if it's a good fit and then participate. We've invested on 27 projects now over the last 8 years. We're at about $28 million in investments, about 22 active right now on 9 projects that range anywhere from mixed use, commercial, retail, residential in Atlanta, Washington, D.C., and the Carolinas, Florida. But we also look at other asset classes: senior assisted, student housing, residential, renovation. So we're not an asset fixed business. We look at the sponsor and the location primarily, and if it meets our parameters, and that's what we do. So it's been exciting. It's been a lot of fun. 8 years in business in April, and our focus now really is to continue to grow our investor base. We've got plenty of projects. We've got a lot of really good sponsors we work with. So I'm not out there trying to find more deals. I want to bring on more people to have the opportunity to see what we do, enjoy what we do, and be part of our team.
Thanks, John. So what projects do you think are the most or have the biggest opportunity right now? Is it, I don't know, workforce housing is a buzzword amongst like the investor communities that I'm part of?
Yeah, it just depends on your appetite. I talk to investors all the time. It just really is, what is your interest? We have folks that like cash flow. We have people that like high yields, higher equity multiples. We have folks that are willing to take on a little risk. They're willing to put up capital and let it sit for, 18, 24, 36 months, getting that accrued return. And, they're fine with that. It just really depends. We're also doing an opportunity zone investment, which is really exciting. Huge project in Washington, D.C. And we're now getting into that new element of asset class. So it's pretty exciting. So it just depends. Again, we look at the sponsor. We're not really asset focused. But yeah, I think it's really a diverse world out there right now. There are some things out there I would stay away from, like, hotels and leisure and some other things out there, really heavy office commercial. But in general, I think we're seeing a nice rebound with the impacts from COVID, which was a struggle. And I think there's a lot of opportunity out there right now.
Thanks, John.
Thank you.
Questions for John or?
Yeah, John, this is Paul Moore. Sounds
Paul.
like we're in a similar business, and great to meet you. How are you finding investors at this point? What is your strategy?
So we usually are organic, Paul, to be honest with you. I've networked here and I've lived in this area for about 10 years. So, I guess if you do something right, you have proof of concept and a good reputation, your name spreads. A lot of our investors who have done well with us and have had success are introducing us. We're on pace to have our best year on the investor side. Our last year and the year before, we averaged about 40 investors. This year, we're on pace for about 120.
Right.
Just hired a director of investor relations who's really excited to have on board. And then we just got Juniper Square. So Juniper Square is going to be our investment portal now. So we're definitely taking on those resources and are seeing some great impacts.
Yeah. And I meant to say thank you for serving our country. We're all appreciative.
It was an honor. Thank you. It was an honor to serve. Thank you.
Thanks, John. Paul, would you like to go next?
Yeah, I'm Paul Moore from Wellings Capital. I had an engineering degree, an MBA, went to work at Ford Motor Company for a number of years in Detroit, then started my own firm, which we sold to a public firm about 23 years ago. got into flipping houses, then flipping waterfront lots at Smith Mountain Lake. It's a resort in Virginia. Was always trying to figure out how to get involved in commercial real estate. Finally, built a couple multifamily facilities in the Bakken oil rush in North Dakota, and ended up writing a book on multifamily investing, humbly entitled The Perfect Investment. And then I decided it wasn't so perfect if it was overheated. And we've come to the conclusion that multifamily is largely overheated unless you have a great acquisition team, a great acquisition pipeline, which we didn't. So we expanded into self-storage and mobile home parks. We actually passively invest, sort of like John. Our goal is to find the very best operators we can and invest heavily in their projects. So that's what we do. And what I'm excited about this year, I guess you could say, is the opportunity to find mom and pop deals. Mom and pop owned projects. An operator of ours can pay top dollar for these projects in the seller's mind. And it really is top dollar. It's more than they ever dreamed they could get for their property. But then when they upgrade them and bring them up to a professionally managed property and a professionally managed company, they can perhaps double the value, sometimes triple or quadruple the equity in a couple of years. And so we've got operators who are doing that. We're very excited about continuing to work with them. Challenges, I'd love to expand our reach. And so we would love to figure out, like every year, our goal is to add one new platform to where we're talking, to potential investors, whether it's, blogging on Bigger Pockets, which I've done for years, or some sort of video reach or something like that. So our challenge and what we're looking for is to figure out, what do we do next? And I've already had a podcast for about 4 years called How to Lose Money. And we're considering other options like that in the future as well.
Thanks, Paul. We're actually going to run a poll. So all of you, a lot of you have actually raised capital, and there are investors in here. We are going to ask, what is the best marketing channel actually to find investors, during post-COVID and whatnot. So any insights or questions for Paul, for the other speakers? Rob, you've done phenomenally well raising capital, I would say, over this last couple of months. Any insights you could share?
For us, it's a lot different because of the challenges of cannabis and the regulations, and for institutions or what we call institutional size investors writing a check more than $1 million, not having a clear path that even though they want to invest, they don't have a vehicle that says that they can invest in something that potentially has federal illegality to it, even though we're not directly in that. So what we learned, and it was a slug fest in crawling through glass for many years to get it figured out, was we realized finally that it was the retail investor, just the small check writers for 50 to 100,000. We have 450 LPs, average check size is 175,000. But we just, because of the structure of our REIT, those are designed for for retail investors. And so we really focused on making this a retail vehicle and marketing directly to them, because they're the decision maker for themselves. And if they want to do it, they can do it themselves. And we focused and built our platforms for that. But we had gone so many different ways with broker dealers and different types of platforms and everything. Ultimately, it was word of mouth and going directly to retail people. And the word of mouth was kind of like through your channels. You guys got a lot of investors, and they told somebody, and then they told somebody. We get 2 to 3 investors a day coming in, and those could be $50,000 to $500,000 a check. So I just think we're in a unique asset class that is fairly interesting to people. At least they want to know about it. And then our performance has been pretty good as well.
Thanks for that, Rob. Mark Moniz. So Mark and I, we've been investing passively together for the last 10 years or so in different deals. Maybe you can share insights as an investor looking for deals. Where do you go to find deals, actually? Oh, Mark, you're muted right now.
Can you hear me, Jeff?
Yep, I can hear you.
Okay, perfect. Yeah, I think I met Jeff at the, so I live in Oceanside, and I believe I met Jeff in Orange County at the local real estate investment association club back when you were doing the cell phone charging business quite a while ago. So I actually work full time for the United States Marine Corps. So I'm a buyer for the Marine Corps. I work at Camp Pendleton and live in Oceanside. And on the side, I've been investing passively, mostly through single family houses, rental houses, some trust deed investments, and investing in a few different syndications, some mobile home parks, self-storage, and a shopping center. Lately, my newest thing, I've been joint venturing with people on basically buying houses subject to, and I'm putting up the funds, and we sell them with owner financing, and split the cash flow 50-50. So it's kind of three paydays there. One is the upfront down payment, the monthly cash flow, and the back end equity. That's my latest thing that I just started. But the reason I'm here on the mastermind, my first time here, is I've got a little bit of a good problem. I have a partner, and I was selling 3 houses, and we've got a little bit of cash, about $450,000, that we're looking to invest in. So we're looking to do a 1031 exchange. And so I thought Jeff invited me to come to the mastermind and let people know what I'm looking for. And I just thought I'd throw it out there and see what's available that would work with a 1031 exchange. So if anyone has ideas or opportunities.
Mark, this is Paul. I'll say that if you get to a place where you have to punt, you're at your 45 days, you probably already know this, but you might want to consider a Delaware statutory trust.
Yeah, thanks, Paul. I actually was on the phone earlier with Mark Creason earlier today, and he said he's going to email me a list of Delaware statutory trusts later on today.
Good. That's a good option. Mark's great.
Mark, any opportunity to bring in funds for an OZ deal, or is it strictly 1031, principal and gains to roll over into a like investment?
What was the question, John?
Yeah, any chance to look at an opportunity zone to roll the gains, or do you have to do a like investment with the principal and the gains to be rolled back in on?
I believe. Yeah, I believe it, as long as it's real estate related. So we're selling 3 houses, and so it could be commercial real estate. I think it just has to be real estate to real estate, is my understanding. It's my first time doing a 1031 exchange.
Yeah, with the 1031, and I'm happy to defer to the other experts in the group. The 1031, I believe, requires you to roll the entire amount, your principal invested and your gain, whereas with the OZ, it's just the gain. So you wouldn't be able to take what you invested in the property if it was original principal. It would just be the gain you earn on that investment. But I will defer to the other experts in the room as well on that.
Yeah, I think that John, I think that assessment is correct. I'm pretty sure on the OZ side, it's strictly capital gains focused. So whatever, if you were going to go into an OZ deal, Mark, whatever your gains were, whatever part of that 450 is capital gains, probably be eligible. Whereas in a 1031, you could probably put all of it. Of course, obviously the other side is you probably have significantly better tax benefits in the OZ side versus the 1031, but just things to consider.
And I'm also placing links to the investor groups that Mark and I have been a part of for many years. And in these groups, we actually share education and content about opportunities that are out there and just for everybody to consider. So Paul, I know that you mentioned in terms of getting exposure, but speaking for myself, I love content. What are the biggest opportunities in 2021? want to know these new geographies. I'm based in California, but I'm now comfortable investing on the East Coast, where John is based out of, and it's just lack of knowledge why I'm not comfortable. And I learned about the cannabis industry through Rob. I consider Rob a thought leader. He put a lot of good content out there about cannabis, and it was just, he pulled me in because he was creating content about cannabis, and I never knew him before a conference that I just met him at. So yeah.
Yeah, but you did help us create content, and that catapulted us to the next spot. So you guys were instrumental in that as well. For us, it's a visual thing for people to see what we're doing, and we needed to take these guys to our facilities and let them film it and see what we're doing, because once you see it, you can understand the asset class a lot better. So.
Thanks, Rob. Kevin Maloney, welcome to the mastermind.
Hey guys, thanks for having me. Rob, great job on Pelorus. I just love your transparency and access, and just the marketing and the things you guys have done is really, it's just fantastic, really setting yourself apart. So good to see the traction, and really, I like watching what you guys are doing. So I'm Kevin Maloney with Larson Capital Management, formerly with a family office here in Newport Beach, California, focused on private equity. We're a real estate firm, offers investment in institutional grade, income producing commercial property, with a focus primarily on commercial office, industrial, and multifamily. I'm most excited right now about a couple of opportunity zone projects we're working on within our Opportunity Zone Fund, typically in the Southeast, Midwest, and South, looking at secondary gateway markets, Denver, Dallas, St. Louis, Huntsville, Charlotte. Our fund is 20% net of fees. Obviously, that's our target. We part of the Larson Holdings, Larson Financial, which is a broker dealer with about $4.5 billion under management. Been around 12 years, done dozens of deals. Got about 23 offices across the country. Our opportunity zone space, two projects that I'm excited about are in St. Louis and Huntsville. A lot of growth, high millennial population, and good wage growth. Both those areas over the long term, good potential. Targeting smaller investors in the 50 to 250,000 range. And really on the calls just to obviously, stay up on what's happening across the board, keep a pulse on the industry, connect with other developers and investors and managers. So thanks for having me, and good to see you all.
Thanks, Kevin. So I actually had a conversation with Paul before in the case for office, and how people want to go back into the office with actually even more space because it's a separation from your home, kids screaming in the background. But Kevin, can you provide some insight on what's going on in the office landscape for that aspect?
Yeah, so one viewpoint of course is a lot of the brokers of course want to see office expand. We need more space between individuals, so possibly more space needed in an office. There are some prime locations, urban core locations that we don't think are going to go away, and there are still some great anchor tenants on these leases for another 5 to 10 years, and getting in at a low basis could create some value. So we're a little bit bullish on certain locations for office. Not big on hospitality or retail right now, but the office, again, for some of these urban cores, we don't think is going to go away. And then we augment that, of course, with multifamily and other commercial assets that we're working on. But, big picture, we think there's some areas for growth in the office space. And we'll see how that transpires.
Kevin, this is Myron Adoteye. I've got a question. I mean, there's been a lot of, chatter about in the office world about trying to reposition existing vacant office and trying to, create more space or turn it into, living quarters or all sorts of other things. How much of that do you think is legitimate? And how much of that do you think is just COVID fueled panic kind of, what are we going to do with all this square footage talk?
I think it's fun to speculate. I mean, it's a great question. I think they're legitimate conversations. People are trying to get creative about what to do with this excess space. I do think that if the vaccine rollout is successful and, we can get the other, 30 to 35% of the population are vaccinated now and or have had exposure to COVID, we're not possibly too far off from getting a place where we'd feel a little bit safer. So I do believe there are legitimate conversations. I think people are trying to get creative on what to do with some space. I do think the work from home is never going to go away. I think, 25% of these smaller businesses may not come back. But I do think that people are going to want to get back in the office for some amount of time, even if it's just part-time, 2 or 3 days a week, just to get a break from the kids and everything else at home, kids and dogs and everything else. But it is hard to predict where it's going to be. I don't see a lot of conversation about massive conversion to more living style spaces, but we're trying to keep an eye out on what's happening there. What else have you heard, Myron, in that area?
No, I mean, I think you covered quite a bit of it as far as certainly the fact that work from home is here to stay in some capacity. I think I've heard that any ideas that people have as far as with widespread distribution of the vaccine and some degree of herd immunity, that there'll be a mass consistent return to the 5 days a week in office environment is probably a fallacy. The question has really been more around what degree to which that's going to be. How much of existing office stock is going to stay within any individual tenant, whether there will be new agreements with alternating arrangements or what that may be. But that's just the little that I've heard on it.
I would agree. And, a lot of people, I think people are enjoying, I know some people in New York that are commuting from Greenwich area and wow, they're really enjoying a little bit more. They're just sleeping a little bit more and there's a little bit more time with family. I think they're enjoying that, avoiding that 3-hour commute. But there's no talk of the large office spaces, going away. I do think that we'll get to a hybrid model where it gives a little bit people some more time to possibly sleep, less commute time. But I don't think I don't think it's going to continue on like this forever. So we're moving forward cautiously with good low basis, properties that have strong tenants in good areas with, again, millennial foundational growth and good wage growth over the next, 5 to 10 year period. But, anecdotally, I'm hearing that, people are apparently working a little bit harder at home. I don't know if it's you can't see me, but I got to show you I'm working harder, but we'll see. I think that some healthy hybrid approach is going to end up being, where we end up. But I'm looking for the next 6 to 12 months to see, how much of it comes back. I think later this year it'll be telling.
On the topic of the work from home, it's interesting to see some of the services around. For example, in the food delivery services, they're actually acquiring delivery companies to help, because in the back in the day, or actually not too long ago, but let's say Google has these massive campuses and kitchens where people can get free food. So now a lot of these companies are looking into, hey, what if we bring those food, deliver it to you instead of you coming into the office? So that way those perks can, but it's interesting to see the industries around this work from home pivot.
Yeah, I was going to add too, I think the commercial office kind of challenge this past year is going to throw off so much more opportunity in other asset classes. Residential home building in the suburbs of tertiary markets is exploding right now. I can speak from just experience and fact, looking down in the Carolinas and like Georgia, there's just so much activity, bigger homes being built with offices, pools, quality of life type stuff. I think, Kevin hit the nail on the head there. And then, retail, a little bit better on the grocery side, depending on who you go with, but medical office also, if you're in a good market with a good medical office area, Atlanta right now, we're in Atlanta, it's booming. And we're excited because medical office is exploding in Midtown. So these are different markets that, you have to be more of a sniper nowadays than a shotgun shooter, let's say, because there's a lot of opportunity that commercial office is going to throw off.
Agreed.
Great. Thanks, John. Myron, would love to have you go next and introduce yourself.
Sure. Myron Adoteye, founder of Aya Enterprises, and my entree into this iteration of CRE happened largely because of the pandemic. I ran across different sponsors that were had experience, had track records, but were having trouble getting deals over the line as far as closing for whether it was acquisitions or refinancing, of all things in Section 8 housing. And that came to me in April of last year, and was able to knock down about $10 million worth of Section 8. From then to the end of the year, discovered there was a market for this apparently, and since then have somewhere around 110 million in my pipeline. What I do is project financing and consulting for on the debt and equity side for talented sponsors, primarily in the Mid-Atlantic. So began in Washington D.C. and going up as far as upstate New York, as down to North Carolina and potentially areas in Georgia. But I work with different lenders, different banks, and essentially help with the due diligence, help with the back and forth as far as various lenders and financiers that a lot of sponsors, are able to do, but just don't really want to do if they don't have to. So I take that off of their hands and basically just help to execute as far as taking a deal, from ideation, initial contract, all the way through to final closing and disbursement, everything in between. So, that's me, that's what I do. And as far as the things I'm excited about the performance of some of these ESG areas like the Section 8 areas that have largely stayed stable and even grown during this time. There hasn't been a crazy amount of disruption as far as rental payments and as far as desire, certainly from municipalities and various city governments. I'm excited about private equity's interest in that space, as well as interest in the opportunity zone space as a whole. I think that with the potential for increased reporting requirements, can come opportunities, no pun intended, for really talented and capable sponsors and developers to bring double bottom line product that not only is able to do good for the community, but also to achieve healthy alpha for LPs and various lenders. So I guess the thing I'm most looking for as far as on the deal side is in that multifamily side, or in that on the retail shopping center side, that any shopping centers that are anchored by strong tenants like groceries and pharmacies, warehouse shopping centers like Costco, any deals that fit within that space that are, let's say, between $1 to $10 million, kind of all in that Mid-Atlantic area. I'd love to have a conversation with anybody in that space, and certainly anybody who's positioning value add Section 8 in that area or even beyond. Would love to talk.
Thanks. Anybody have any feedback? Yeah, I definitely know Section 8 workforce housing, affordable housing, mobile home parks have very popular this time around for even investors and even just build to rent in terms of looking at cash flow. So
it's one of those things, and I can see, Rob, you want to talk. I won't talk too long. It's one of those things where on its face, it doesn't seem really sexy at all. It seems kind of backwards as far as on its face, but once one carves into the numbers, it's a different situation. So.
Rob, were you going to say something?
I was just going to say something. I just recently sold a portfolio for my mother-in-law, and the rents, I didn't know that her portfolio of rents was under market by 40%, and it really crushed us with the COVID laws, and you couldn't adjust the rents more than, I think, 8 or 10% per year, and we couldn't get the people to evict them, and so this is it was a fairly large portfolio, and it really impacted us. So it's the the COVID stuff has had some unintended consequences. They kept them low to make sure that they never, had a big turnaround. But when you go to sell that portfolio, it was always thought that because they were month to month, you would be able to bring those up and change or evict those people, and we couldn't do it because of COVID. They were paying the rent. So there's some unintended consequences that we're learning from this stuff.
And there are questions from the audience, Myron. What are your thoughts on the potential taxation of 1031 exchange? What will happen to the cap rates? If you can give a high level overview on what you see, that'd be great.
Sure. I mean, you hear stuff about the 1031 taxation bit. I mean, honestly, I'll believe it when I see it. Like, John's close to Washington, so he understands, what I'm talking about. When, politicians say a lot of stuff, but as far as, whether or not it actually gets over the line and whether or not you actually have a legitimate, serious, impactful, 1031 exchange that's going to have any real, cap rate compression, consequences. I mean, I'll believe it when I see it. Look, the short answer is, if there was something like that passed, naturally, it's going to have, major impact on trades, major impact on new investments, major impact on capital, on cap rates. You'll probably see a lot fewer of those and a lot bigger flight to opportunity zones. I mean, that's the short answer, right? But I'll believe it when I see it, kind of deal. As far as any kind of real 1031 taxation.
Yeah. Joshua's comment here, contrary to Myron's comment, I found affordable workforce very sexy. I've loved mobile home parks, and they were sexy years ago, and now private equity is trying to come in, trying to buy these entire portfolios, and sexy now, and just cash flow has definitely been sexy.
those per day rates in those mobile home parks and those monthly rates in those mobile home parks are a different thing. It's a different thing that just, it's one of those things, you see it and you're like, this doesn't make sense. I don't understand how this is what works. But I mean, there's a market for it. I mean, the bottom line is there's a market for it, and alpha, as we all know, is king. So if you can find it,
I love it.
Let's do it.
Kent, we'd love to have you go next. You must see a lot of deals and know of a lot of opportunities, and you're definitely best dressed. So thanks for looking the part.
Yeah, I thought I'd get out of my sweatshirt and my sweatpants for a while and throw on a blazer. I had to dress, I had to dust it off a little bit. It's been sitting in my closet for a while as we've been quarantined, but thank you. So my name is Kent Ritter. I'm a managing director with a firm called Birge and Held. We're a private equity multifamily real estate firm based in Indianapolis, Indiana. We focus on really all aspects of multifamily, from ground up development to tax credit deals to value add, heavy and light and all different shapes and forms. We got about $1.5 billion in assets under management currently. It's about 15,000 units in about 10 states. So we're primarily focused in the Midwest, and we've got properties in the Southeast and then out west in Colorado as well. Prior to joining Birge and Held, I was a management consultant. Spent about 12 years flying around the country working with large organizations and helping them solve problems. And it got to the point in my career where we actually started a business. It was a boutique management consulting firm, and I was running the business and flying around everywhere. And I started to develop a family and said, hey, it's not really much time for the family. So I decided to make an exit from there and sought out real estate investing. I started as a passive investor, give myself the freedom to be the kind of father and husband I wanted to be. And then from there, I can't sit still. So I started getting active, started, talking with the sponsors. And Birge and Held was one of the companies that actually I was investing with. And we developed a relationship, and I came on as a partner. And within that, I'm building out kind of what I'm doing, and what I'm excited about is really the same thing. Building out a portfolio of properties that are kind of diamond in the rough properties, smaller than what a firm our size would typically go after, typically under about 150 units. But somebody mentioned mom and pops earlier. Love buying from mom and pops. That's a lot of the folks that we are buying from. We're finding good values, and we're focusing on really a couple things. One is just developing a technology platform that allows us to manage these properties efficiently. So it's one of the things I'm most excited about is all the technology. Think about PropTech and these other buzzwords that are available right now and how they're changing the landscape of multifamily. And so we're heavily investing in a lot of that. We're taking things like leases and even tours virtual, allowing people to go tour themselves, do self-guided things, putting smart locks on, stuff like that. So really leveraging the efficiency of all the technology that's out there. The other thing I'm excited about kind of blends with what do I need. So Birge and Held has traditionally raised money from ultra high net worth folks, from private equity firms, but not traditionally from retail investors. And so that's the other thing I've brought in our portfolio is really a focus on the retail investor, really trying to democratize private investing, let people into these deals. So I'm excited to see more interest than ever before in these deals. Excited to be able to open our deals up to a larger audience, and then and just build out that network.
Thanks, Ken. Anybody have any comments, questions?
What's the market like in your area right now? I know it was pretty strong for a long time.
Yeah, so the market is great. So if you're talking about Indianapolis, from a multifamily perspective, the market is extremely strong. Prices have continued to increase. There's a ton of demand. And even though there's quite a bit of supply, I think demand is even outpacing. So the Indianapolis market has been very strong, multifamily perspective. From a performance perspective, across our portfolio, which is heavily allocated in Indiana, we've stated about 95% collections. So even through the pandemic, it's been strong. We haven't, we expected, obviously, I think as everyone did, kind of could have been what was pretty adverse, and really we haven't seen much of a dip at all. And yeah, so I think things in the Midwest, it's one of the reasons that we're based in the Midwest and we like the Midwest is because, we don't have those cycles. It's fairly steady eddy, solid growth. And because you're talking about workforce housing, our average rents in our portfolio are about $800. So when you compare that to the incomes, and it's still relatively affordable. So I think those are reasons why we've seen that strong performance.
And you mentioned PropTech. What are some of the most game-changing PropTech companies you see out there that's going to change? I know modular housing has been a big buzzword.
Yeah, so companies is tough because there's a million of them, and that's part of the explosion. Is there's I think I saw there's $34 billion invested in PropTech in 2019, another $27 billion in 20. So, but some of the things that we're working on, and I can tell you some of the people we're partnering with. So for us, smart locks are kind of the front door, metaphorically, and I guess literally of all this technology. So putting the smart locks on, we have a couple of different partners based on to kind of match the quality of the asset, but we like Schlage as a really, really solid product. I think what's important is the technology. We are using a Bluetooth low energy technology as opposed to something that sits on a network and has to have a live hotspot, if you will. We're a big user of RealPage across our platform. So we work with a company called Stratus, which is a RealPage company they're just acquired that actually it's like the app that allows you to control the smart locks remotely. And then we work with a group called Tour 24, which is a self-guided tour company that actually allows folks to sign up online, come in, tour a property at their own time without having to be with a leasing agent, and go through a curated tour where they're actually being talked to on their phone as they're going through the property because they're being tracked for geolocation as they go through. They walk up to the pool and it says, "Oh, welcome to the pool. Here's all the info about the pool," things like that. So those are some of the things that we're doing to just build management efficiencies. And other things we're looking at is building out a call center to centralize leasing and maintenance requests. And then we use RealPage's product from an AI chatbot standpoint to engage with folks on our website.
Yeah, that's awesome. And those technologies and tools that we're seeing is actually game changers for some of these operators. Makes life easier. We do have a poll. We wanted to send this out. So both panelists and attendees, you guys have a poll. Take a few seconds to answer. Basically, we get this question a lot. What is the best marketing channel to find investors? So everybody take a few seconds, jot it down. We're getting pretty close to the end, so we want to get answers here so we can address them. Also, we have a private Slack mastermind channel that we're going to be sending all the speakers to and some of the attendees to join, and where you can connect with a lot of the speakers here and all of the speakers from our past mastermind. So a lot of the thought leaders will be there.
Awesome.
Richard, we'd love to have you go next. I know you're building out your own platform, and I would love to learn about condo.com.
Jeffrey, Ivan, thank you. So I'm Richard Swerdlow. I'm the founder and CEO of condo.com. I'm a lawyer by trade, real estate lawyer, got into the online real estate business about 15 years ago. So we really have three platforms. The first is a consumer-facing search platform. It's national. It's called condo.com. So think Zillow for condos. We're a licensed broker nationally. We aggregate millions of listings, and we're really in the lead gen business. But we've partnered exclusively with one brokerage partner per market, and we've productized every single condo building in the country. And then we assign those buildings to agents. So we basically turn a broker into a building expert in a market. We put their agents on every building. We give a bunch of building tools. So that's condo.com. We also have condos, plural.com, and that will be rolled out probably in the next 90 days into a developer direct new construction only platform with the ability to sort of disrupt the middleman. The developers are tired of paying excessive brokerage commissions to brokers that sort of babysit in the sales center. So it will be non-MLS, developer direct, online sales, almost like Carvana, but for condos, just for new construction. And then the last opportunity that we're working on was really post-pandemic. We realized that there was going to be a big opportunity for investors and funds and institutions to buy bulk condo portfolios. So we launched something called bulk condo deals, and we've aggregated about 300 million worth of bulk portfolios. We just added 80 units in Miami last week, another 20 in New York, a bunch in Chicago. So it's a bulk marketplace where where professional investors can go and find bulk opportunities, and developers can post confidentially. That's the big thing. Developers want to be able to sell in bulk, but they don't want to alert their financial partners or the regular retail community that they're giving a haircut on the sale of their properties. So those are three ventures that we're involved with. I'm really excited about sort of the use of technology to continue to disrupt, to allow both consumers and institutions to take some of the friction out of transactions, to reduce expenses. We're excited about augmented reality as a sort of digital tool to allow consumers to view units without actually being in them, to sort of walk down a major thoroughfare in a major city and to see all the available inventory in a building. In terms of the stuff we're looking for, and we pay finder's fees and referral fees, we're interested in brokerage partners. So if you know any sort of big brokers that have a bunch of agents in any of the major metros, the NFL cities, we're looking for partners to send our leads and to help them generate more revenue for condo.com. For condos.com, we're looking for developers that want to sell direct, that have big swaths of inventory, either pre-sale or existing inventory. And then for bulk condo deals, we're looking for either financial institutions or developers that are sitting on inventory, it's slow moving, and they want to sell it to an institution, and they're willing to sort of take a haircut in order to get on with their lives and move on to the next project.
Nice. Thanks, Richard.
Thank you.
Any questions or feedback from anybody?
Richard, I got a question. Do you have much experience with taking apartments and converting them into condos?
I don't per se, but a lot of my investors and a lot of partners that we work with do. So if you have condo conversions, you're looking for a developer that will take them and go through the sort of proper filings to do the conversion at the state level?
No, we've done it a couple times and have had a lot of success. I'm just wondering if we if you start to see more of that, if you see, especially in more urban areas, I mean, we're seeing in urban areas, especially class A urban multifamily is what's been hit the hardest. I mean, we have some in our portfolio in downtown Indy that have lagged, performance of the suburban, B portfolio. Just wondering if, condos become a likely kind of exit strategy for some of those properties.
Yeah, no, for sure. Let's stay in touch. I'll shoot you a note afterwards. We're actually seeing it the other way, where a lot of developers are converting and going back to multifamily because they think the yields, and it's easier to put rental income and to sell for a cap rate when they've got a failed building where they just say, geez, we're sitting on these units, we can't get the sort of price per square foot, so let's turn them into rentals and then sell them to a more stabilized buyer of income.
Yeah. Well, we should stay in touch on those then.
Yep.
So both ways.
For sure.
We had a project like that with COVID as well. We had a 90-unit condo deal that we just couldn't get a debt loan. Our debt lender walked away with COVID, and we had to underwrite it as a fully stabilized building just because we weren't going to get the debt loan. And so it took us 8 months, and they wouldn't give us the cash because they don't lend on dirt very easily. So it's definitely a challenge, but we learned a ton. And yeah, lower leverage debt, but the deal is still going to be a very good one.
Yeah, there's a whole bunch of FHA programs and other sort of financial programs that are available if you're building multifamily with rental income versus, condo that you got to have a pre-sales requirement and it's a longer sales cycle. So yeah, that makes sense.
Absolutely.
Thanks, Richard. Dan, would love to have you finish it off and introduce yourself. And
Yeah, I'm Dan Goelz. I am recently joined Freedom Development Group here in Chicago. We are a capital V, capital A value add buyer. Some of the properties we have acquired have been an empty hospital, a 50% leased and closed regional mall. We're not afraid of risk. We buy it right and reposition. One of the things I certainly wanted to mention, I think is being critical, especially with some of those type of assets, is community buy-in. Villages are under pressure, cities are under pressure. To have a non-performing asset like the ones we acquire doesn't do anyone any good, doesn't do the residents good, doesn't help the tax base and the like. So what we try to do is acquire properties smartly, bring in bridge equity with participation ideally from a community. You hear a lot of stuff about public-private partnerships, but I think the smart communities are the ones that may not be equity, but may give some credit support, certainly be able to expedite approval process, repurposing and the like. We bought an empty office building in St. Paul, Minnesota that's converting to apartments. This empty hospital we bought outside of Chicago is gaining a lot of interest from folks, but certainly those sort of assets are rife with challenges, but also rife with opportunities. So what I am, I'm our head investment officer. I'm responsible for sourcing debt and equity in a creative way, largely from the private base. These are not institutional type deals at this point. They may be on the exit, but what I like to do, and kind of commensurate with my background, in prior life, I was at Capri Capital. We formed, I think, what you might call it the first mezzanine dedicated fund in real estate back in 1999. So heavy on the structured finance, but being able to tailor to meet needs of the client, in this case, my company, Freedom, and the investors. So debt, equity, all things in between. And I'm glad to be here today. Thank you for inviting me.
Thank you, Dan. Those are some pretty good insights. I wanted to share the results of our poll with everyone. So you can see number one, referrals from his existing networks was number one across all the people that have answered that poll. We also have a lot of questions for Richard specifically in the Q&A. So definitely take the time and see if you can answer them in the Zoom Q&A. Jeff, did you have anything else to mention?
Yeah, and going along to the best marketing channel to find investors, like referrals from existing network. That's really the purpose of these masterminds, to bring together thought leaders like yourselves, to meet each other, do business with each other, share deals, connections, whatnot. And would love to have you for the next one. As Ivan mentioned, we do have a private Slack channel where everybody can converse further. And also there's a lot of attendees that are listening and respect all of you and your insights on what you're working on and just see how they can help. So just want to say thank you to everybody for sharing your time with us this afternoon.